Hi, morning everyone. Right now we will be starting today's research morning call. First off, we'll have SIA capital raising exercise, followed by the banking monthly, the REIT monthly, the China monthly, the technical pulse, as well as our Singapore second quarter exercise. So first off, we'll have Timothy, our credit analyst, who will be talking about the SIA capital raising exercise.
Hi, good morning, everyone. Today I'll be talking about the capital raising exercise of SIA to tide them through the COVID-19 situation. Okay, in summary, right, SIA will be raising about $8.8 billion of capital to help them through this crisis. So this will be issued through rights shares and through rights mandatory convertible bonds, MCBs for short. So to touch on the rights shares for a start, they'll be raising about 5.3 billion through these rights shares, and you'll be able to trade these rights. So if you do not want to subscribe to the rights, you can sell them in the market. So they'll be issuing 3 rights for every 2 shares of SIA that you own, and the issue price is $3. So based on the last Thursday's closing price, the theoretical X rights price is $4.25. So for existing shareholders, if you do not subscribe to the rights, you'll be based on the calculations, you see about a 30% dilution to your current share value. So for existing shareholders, if you do not want to prevent a dilution of your existing shares price, it's recommended that you subscribe to the rights shares. Whereas for non-shareholders, you can take a gamble. So you can purchase the rights off the market and then subscribe to the rights for $3. And if you are able to purchase the rights and then convert for a price that is less than the theoretical X rights price of $4.25, you may stand a chance to profit by selling the rights shares in the market after they start trading. So that's one way that you can profit from this the rights shares. And the second way they're going to raise the funds is through the rights mandatory convertible bonds. They raised about 3.5 billion this round, and then possibly another 6.2 billion the next round. These are also tradable, so you can sell off the rights if you want to. And how this works is there is a zero coupon bond. So meaning that they pay back your principal and returns. They'll pay the returns only at maturity or when SIA redeems the bond, if they redeem the bond at an earlier date, paid to you in a lump sum. So for every 100 shares of SIA that you own, you receive 295 rights MCB, and you'll be able to subscribe to one MCB for $1 each. And how this works is that for every $1,000 of MCBs that you invested in, okay, at maturity date, this $1,000 will be worth $1,806.11. But at maturity date, this will not be paid to you in cash, but they'll pay to you in shares, exercised at the price of $4.84. So if the bonds go on until maturity date, you receive, for every $1,000 that you invested in this MCB, this rights MCB, you receive 373 SIA shares at a cost of around $2.68. So if SIA's price is higher than $2.68, you gain a profit. But there's a risk that if SIA's share price is lower than $2.68, then you actually make a loss on this rights MCB if you subscribe. So one way to get the returns is through maturity in 10 years time. The other way is that if SIA redeems the bonds at an earlier date. So if you look at figure 3 on the right hand side, every 6 months from this date until the maturity date in 10 years time, SIA has the option to recall the bonds, redeem the bonds. And so for example, if they redeem the bonds 2 years later, the value of your bonds, $1,000 will become $1,082.43, and that represents a 4% annual return. And the difference is that for early redemption, you receive in cash rather than in shares. So this is a good thing for you because then there is no share price risk, and also that the share price of existing shareholders doesn't get diluted from additional shares being put onto the market if the MCBs are converted into shares instead. For whether you should subscribe to the MCBs or not, because these MCBs are zero coupon, it reduces your liquidity, it reduces your cash flow because you will not get coupons paid regularly like normal bonds. So your cash will be stuck until redemption or maturity. And the risk is that if it holds until maturity and converts it, and the share price is lower than $2.68, there's a risk that you make a loss also. So for the rights MCB, we have a view that the money can be put elsewhere for better use, for better cash flow and for possibly better returns. So in summary, look at figure 2. So if for every 1,000 SIA shares that you own, you receive 1,500 shares, rights shares, and that requires you to invest $4,500 to subscribe to all the new rights to prevent dilution. And the rights MCB, you receive 2,950 rights MCB, which you can subscribe to $1 each for MCB. So the total investment fund outflow that you, if you want to subscribe fully to all the rights, is $7,450 for every 1,000 SIA shares. So back to you, Wee Kwang.
Okay, thank you, Timothy. So right now I'll be talking about the Singapore Banking Monthly. First off, next. Okay, so since the March, right, we already see 2 interest rate cuts by the Federal Reserve, but we did observe, what we did observe is that local lending rates through the 3-month SIBOR and 3-month SOR actually fell less than proportionate to the fall in the interest rate. So what happened was that SIBOR actually fell only about 73 basis points, and SOR, although it fell 123 basis points initially, but it rebounded off roughly 50 basis points to similar levels to the drop in SIBOR. So what happens is that if you can see the right side, there's actually a slight rebound of the thing, which will help to hold up NIM for the local banks. So for the first quarter result that are coming out in 1 month's time, what we are seeing is, what we will probably see is that we'll see some low single-digit compression from the NIMs from the banks due to a cyclical structure of the banks that has already been previously guided by the management previously. However, for the full year NIM compression, we are likely observe it only in the second half of the year, and the entire year's NIM compression will come in at about 15 to 20 basis points. And next up, we'll take a look at the loans details. So the second part is for HIBOR. So what we see for HIBOR is a similar observation for SIBOR and SOR. So HIBOR also rebounded in March itself. So this will also help the bank, where most of it outside of Singapore is in Hong Kong already. Then next, we move on to the loans. So for loans, loans growth was actually quite steady at about 3.05% year on year. All we see is that over the past 4 months, we can see it is relatively stable, and we will likely see the loans growth for the entire year to come in pretty stable, considering that MES has stepped in to help buoy loans numbers in during this period of time during the pandemic. So, however, what we see is that there will be an industry-wide loan restructuring because SMEs and companies will start to extend the tenor of their loans, as well as maybe defer payment on some interest and some principal as well. However, what we need to take note of is that this provisioning will not affect the amount of allowances that are catered for by the banks itself. So I'll now move on to talk about a little bit about some of the measures that are put in place by MES. Okay, so on the left-hand side, we can see was based on a circular dated 31st of March. So on 31st of March, the MES actually came out and said that together with the financial institutions, they will be supporting SMEs and individuals. For SMEs, on secured SME loans, what we see is that the SMEs can actually opt to defer principal payment. However, they must make sure that they do not have any payments that are past 90 days due as of 6th of April. So this will help banks as well. So they don't need to take this into account as their NPLs. However, for the SMEs themselves, they need to know whether this extension in loan repayment, they need to consider, because interest will continue accruing if the principal payment is deferred. Yeah, and it's on an opt-in basis, so we might not actually see as large of a scale as it is, especially when the SMEs themselves choose to pay off their loans during this period of time just to save up on the interest payments. Then for new loans that are taking up, actually, MAS has also provided for this MAS SGD facility under Enterprise Singapore. So we can see there's two schemes, one is the SME Working Capital Loan Scheme, as well as the Temporary Bridging Loan Program. So these two programs itself will help, will allow banks to gain access to low-cost funds and probably promote some loans, extension of loans for to the SMEs as well. But the criteria is that they must pass on the cost savings that they get from these schemes onto the SMEs. So it will help them as well over the long term. For individuals, we see that residential property loans, actually, individuals can actually choose to defer both principal payment and interest as well, but it's also on an opt-in basis, because as we know, interest will also accrue when you actually choose to defer it. And similarly to the SMEs, they must not have any payments that are past 90 days due. This principal payment also, and then we have for the personal unsecured credit, i.e. your credit card fees. For credit card, they can be actually converted into a term loan at a reduced rate of interest, which is capped at 8%, compared to the usual 26% on your credit card fees. So the term of loan can be converted up to 5 years and only available to individuals who actually can prove they actually suffered a loss of 25% or more of your monthly income after the 1st of February. And this application can be from 6th of April all the way to December. So for these personal unsecured credit loans, what will happen is we might actually see some reduced net interest income. Then on the right hand side, we can see actually on a circular that was announced last week, 6th of April, there are some adjustments to the capital and liquidity requirements. So first of all, we see that there's a full recognition of this RLAR. So what is this? It is a certain amount of money that the banks must set aside to consider a buffer when there's exceptional allowance losses. Last time it was granted limited recognition. Now is a full recognition as a tier 2 capital, which means that the capital buffer that the banks have are actually more now. So they don't have to be worried about using their capital out to loans and etc. And secondly, you also see that there's a setting account loan loss allowances. So what happens is, we know currently the banks are all using this expected credit loss model to forecast their possible loan loss allowances in the future. So what happens is the government actually come out and say that, hey, because there are some extraordinary measures that the government is actually providing for at-risk businesses like SMEs, when you actually take into account these possible losses, you can also make sure that you can also take into account the grants that government will provide for these SMEs when provisioning for your losses. So they can actually reduce the amount of losses that they take on when they calculate this based on the new model of the ECL. And they also increase their risk share of loans to 90% from 80%, initially. So what happens now is that every $1 loss in your of default on your loans, right, MAS will actually give you 90 cents. So this will greatly reduce the amount of risk that the banks are taking on when they extend loans out to these businesses. Yeah, so it will promote loans growth definitely for this year. So we are likely to see the cash flow. We are likely to see loans still pretty healthy and at around 3% for the entire year. Okay, and then another thing we see is that, okay, so we know the equity markets is experiencing large amounts of volatility, and for both the securities and the derivatives business is at record levels since the 2008 global financial crisis peaks. So we see that securities SDAV is up 114% year-on-year in March, and the derivatives volume is up 34% year-on-year in March. So taking both of these into account, right, when we put in our model, it seems like SGX will likely beat earnings estimates by about 20 to 25% for the entire quarter ending March. So this is a very stellar result. As you can see, also the share price of SGX has also been rallying in recently. Yeah, and that's all for me. Next. So in summary, some of the monetary policies that MAS has come out to provide relief for local banks will help the banks to tide through this short-term, across this short term. So they'll provide low-cost funding and also reduce the risk taken on by the banks itself when extending loans during this short term. So in the short term, when individuals, businesses, they start to push back their loan repayment, there might be a short-term pinch because the cash flow, in terms of cash flow, you might not be able to get back as much in the short term. But after this entire pandemic comes to pass, we are likely to see better long-term financial benefits. Yeah. So currently we are accumulating, maintaining overweight on all three banks. Yeah, all of them are very attractive right now. And next, I'll pass the presentation to Natalie, who will be talking about the REITs monthly.
Hi, thank you, Wee Kuang. So moving on to my first slide. On the first slide, you see the FTSE REIT index currently underperforming the STI, and this is largely hurt by the containment measures. So year to date, the REIT index is down by 23%. This compares to the STI, which is down by about 21%, and largely dragged down by the hospitality sector, which year to date has recorded total returns of negative 51%. On to the next slide. So here are some of the measures that the government has put in place. And in summary, there's 100% property tax rebate for hospitality and retail properties, as well as a 30% tax rebate for commercial and industrial. The stricter containment measures, such as the mandated closure of bars and non-essential businesses, as well as the COVID-19 temporary measure bill that will be may be passed, is it's supposed to be approved or be voted in last week. However, due to public feedback, this bill has not passed yet. And this COVID-19 bill is actually to provide temporary relief for the inability to perform contractual obligations. And this covers non-residential leases, so like retail leases, commercial leases, and the leases on industrial assets. And it's to prevent the contracting party, which is the landlords, from taking legal action against or terminating the leases for 6 months. So this is actually quite punitive to REITs because it prevents the landlords from eventually trying to show the space to potential tenants and lease out the space, even though their current tenants show signs of default. So the REITs Association of Singapore, REITAS, they have asked the government, they have written an open letter to the government and asked the government to shelter the REITs from the financial impact of rental deferments, such as underwritten financial support. So the impact for the REITs, for the retail sector, we see as the greatest casualty of these measures. As retail and F&B tenants have been actively engaging landlords for assistance and rebates. The retail REITs have actually committed to passing on the property tax rebates, and they have offered additional rental rebates. So for CMT and FCT, the REITs have offered an additional 1 month of rental rebates for their tenants. REITs also can explore other creative ways of trying to pass the money back to the REIT, such as SPH REIT. The REIT management has actually elected for pay cuts across the board to reduce management fees by up to 10%, and this savings will be passed back to the REIT. So this can help shore up the DPU, but actually this is a very, very small amount. But this is also one possible way in which the REITs can help. The management of the REITs can help the REIT unit holders. So from the COVID-19 bill, we see a cash flow mismatch during the 6 to 12 months rental deferment period. However, the REITs can actually dip into their retained earnings or capital gains to shore up DPU, or they might actually cut DPU, which we are in view that it will be the latter, because REITs are not averse to cutting DPU. On to the next slide. So I'll be going into the subsector views, as well as focusing specifically on how the COVID situation has impacted the subsectors. So for the RSI, no surprise there, it actually fell by 11.7% in February. This is largely dragged down by the fashion and F&B index. And these two trade segments make up the bulk of mall tenants. So the impending COVID-19 bill, which is the 6 to 12 months rental deferment period, actually causes a higher bad debt risk for the REITs. And we expect the suburban malls to perform better than central malls during the circuit breaker period, as most residents will be working from home due to the workplace closures. However, this might boost the takeaway and delivery F&B business and the grocery spending in the suburban malls, which are household catchments. So overall, we do expect some shorter lease terms and mildly negative rental reversion on leases expiring in 2020 to 2021, as the landlords exercise some flexibility in order to help tenants to pull through this period, as well as maintain occupancy levels. Moving on to the hospitality subsector. Once again, no surprise, the IVA for February was negative 50. We expect the IVA for the month of March to be around negative 90 year on year. Hotel occupancy was supplemented by returning residents who choose to serve out their stay-home notice in hotels and accommodations. So some of the hotel operators have actually offered some stay-home packages, some stay-home notice packages of about 14 days with better room rates. And this is helping to shore up the occupancy in hotels and accommodations. So accommodations with higher exposure to longer staying corporate clients, such as service residences, they experience better and higher occupancy of 60%. And this compares to the hotel peers, whose occupancy is in the range of 30 to 70%. So some hospitality REITs are actually exploring the possibility of accelerating their asset enhancement initiatives, or AEIs, and repair and maintenance timelines to coincide with the lull period, and hence future-proofing their portfolios to command better room rates in time for the pickup post-COVID-19. So one of these REITs is actually OUECT. So one thing to note is that for the Singapore-listed hospitality REITs, most of them have revenue structures with at least 50% of revenue in the form of stable sources. So stable sources is defined as master leases or leases with some sort of minimum guaranteed income. Moving on, for the commercial sector, so containment measures have actually pushed businesses to implement their business continuity plans and telecommuting, and the successful implementation of remote working will cause companies to rethink their space requirements. So this is an accelerated technology-enabled structural change in the demand for office space. So although the commercial supply is benign in the coming years, the right sizing of space by the tenants will threaten the occupancy and may put downward pressure on rents. For the industrial subsector, the COVID-19 outbreak reiterated the importance of e-commerce and cloud storage as trends of the future. And this will increase the demand for logistic assets and data centers. So for some color on the kind of leases in data centers, so data center tenants, they plan and they lease enough space or racks for the next 3 to 5 years. So if they currently require 1 rack, they might actually lease up to the space for 5 racks in advance. And this telecommuting has caused the clients to dip into the racks earmarked for future use. So they will, post-COVID, they will probably need to ramp up and replenish the space capacity. So for factory and light industrial assets that have supply chains affected and are largely occupied by SMEs, we feel that this might come under pressure for these asset classes. So the negative 300 points fall in the FTSE index has actually translated into the yield spread and the dividend yield expanding. So the dividend yield spread is currently at the 2.75 standard deviation level, and this compares to the -1 to -2 standard deviation levels we have seen in 2019. So dividend yield currently is at 6.2%, and this compares to the average last year of 4.6%. As well as dividends yield spread at 5.2%, and this compares to the dividend yield spread of 2.6% last year. We're upgrading the REIT sector to overweight on attractive price to net asset values, or price to NAVs. So for the hospitality sector, maybe I'll explain the chart. So the red line actually shows the average price to NAVs post GFC. And the blue bar actually shows the current price to NAV. So the further away the blue bar is from the average the red line, which is the average, is the amount of perceived discount or attractiveness. So you can see that for healthcare and the industrial sector, the current price to NAVs are very similar or very near to the historical average price to NAVs. Drawing your attention to the hospitality sector, which is currently trading at 0.45 times price to NAV, and this is about 50% lower than the average price to NAVs that we have seen post GFC. And for the retail sector, currently it is 32%, 33% below the historical price to NAVs. So this presents relatively attractive entries. However, we also note that in terms of the current price to NAV to the trough price to NAVs, which is denoted by the green diamond, the hospitality sector and the retail sector are currently still about 36% and 40% away from the trough price to NAVs. So the sharp decline in prices, which is for the FTSE index is about negative 30%, presents an attractive entry. And hindsight is always 2020, so prices may continue falling in the near term, but we feel that this presents opportunities to average down entry prices. So for our stock picks, we prefer Fraser Centrepoint Trust or FCT, and this is due to the suburban mall portfolio, which is protected by necessity spending, and necessity spending roughly accounts for about 59% of the net leasable area and 52% of the gross rental income. We also feel that the long-term organic and inorganic growth drivers for FCT remain intact. So the organic growth drivers for FCT is the growth in catchment size in around the 3 of their largest malls, as well as their very robust acquisition pipeline. And for reasons of lower concentration risk, which provides stable earning, we like AREIT for their diversified tenant base and asset classes, as well as Ascott Residence Trust, 50-50 growth to stable lease structure and very well diversified geographical asset allocation. Moving on. Okay, so for our subsector preferences, we like the commercial and industrial due to tapering commercial supply and cautious on hospitality and retail. On the right, you see our stock coverages, but however, our target prices are currently under review in light of the situation, and we'll review them systematically. That's all for me. I'm moving on to Mike for China Monthly.
Thank you, Natalie. I will have a brief introductions on the March China macroeconomic. Based on the high frequency test, we believe the China economic will improve in March, and we are positive on the construction sectors. So first one, for industrial sectors, we are seeing the lockdown slowly being lifted across the China's as China's economic resumes activity. From the blue lines, we can see the coal consumptions for the power generations in February and in March have been reached to the 80% of the same period last year. Combined with the March productions, the PMI reached the highest since the 2018s. We expect the declines of industrial value add in March will be narrowed compared to February. For the consumer sectors, we observed the automobile sales, which is the red lines, in March continue to fall, but the declines was narrow compared to February. We expect the declines of the China's automobiles consumptions and the sales of the consumer goods in the March will be narrow compared to the February. For the fixed asset investment, we observed the steel inventory, which is the red lines, reached a peak in the mid-March and begin to fall back in the late March and early April. Refer to the steel manufacturing index. We are seeing the steel manufacturing continue to rise from the end of February. So we believe that the declines of the steel inventory from the peak is mainly due to the rise of the demand. In March, also, we observed the scales of the special debt financings reached over the 115 billion RMB. And totally in the first quarters of the 2020, the scale of the special debt financings reached over 1,000 billion RMB, an increase of over 300 billion RMB increased compared to the 2019 first quarter. We believe that with the gradual implementations of the various new infrastructure projects in China, infrastructure financings will be converted into the investment expenditure, and we expect the infrastructure investment will pick up significantly in March. Investment-wise, we are overweight on the China construction material sectors and the infrastructure sectors. For the construction material sectors, we are positive mainly due to the rising demand, also based on the rebound of the PMI of the construction industries and its economy in March. We expect that construction material sector's performance in April will be further improved. This is a list of the China construction materials companies listed on A-shares. China's construction material sectors currently are trading at about 12 times the PE, lower than the 5 times the PEs of the total A-share. For the infrastructure sectors, we are positive on the infrastructure sectors mainly due to the large scales of the investment into the infrastructure project. And we believe we will convert into the investment expenditures in March, and we expect the growth of the infrastructure investment will pick up significantly in March. This is a list of the infrastructures, the companies listed on Hong Kong and on A-shares. I will move on to the Wei Ren for the technical analysis.
Hi, thank you, Thierry and Mike. So today I'll go through the Straits Times Index only. So it will be a very short sharing session. So yes, thank you. Yes, so for Straits Times Index, I'll be using a monthly chart. Monthly chart will show you a very clear picture on how the wave count and the wave analysis is going to work. So I believe that most of you know that for the past, I think last week, the STI have a very some sort of strong rebound, but however we think that the rebound is not a sign of recovery, rather a sign of correction, preparing for a greater sell-off. If you look at why do I say so? If you look at the wave count, actually, the sub-wave or the wave C is actually not completed yet. Although wave Y, sorry. The three wave has the third wave has been completed. The strongest wave has been completed, but you look at the bullish momentum is kind of slow. And then we have a target at 38.2 and 50%, which I will show you on the weekly chart later. So we have a minimum target for wave Y. So it will be at 1,007 to 1,500 levels. But however, should the impulse sell for wave 5 of the Y leg is strong, we can see an extended wave 5 towards the and should it break 1,000, we'll see the maximum target for wave 5 at 800 plus. I know that is kind of, it sounds crazy, but we see how the market is going to evolve itself, the index going itself. Okay, so next chart, the weekly chart. Okay, so like I mentioned earlier, price had a surprise rally on Friday, especially on Friday. Weekly chart shows a clear picture of a continuing limited upside to 4.4. I will check the current price action. So I think that should it fall or should it rise on the daily chart? I believe that minimum target we should be seeing limited upside to 2672.83. Okay, upside target will be at 38.2% of Fibonacci percent, 50% of the Fibonacci retracement level of wave 3. So with that, I end off my presentation first. I'll move on to Paul.
Yeah, thanks, Wei Ren. Move on. This is just regarding our second quarter strategy report that was released just a couple of days ago. Anyway, these are some of the reasons why we are positive on the market. Next slide. Okay. Anyway, firstly, as we can see on the chart, and which is all over the news, we know that the breakout can be contained. Of course, at the expense of tremendous economic costs, but you can see that that the containment has happened in South Korea, China. It's also happening in Italy to a certain extent, which means that the new patient loads are actually declining, as you can see from this chart. Next slide. The second reason why we are positive is also because there is fear by governments and society, which is ironically a positive. What it means is that there have been lockdowns, and if you can see from this chart, this is not an exhaustive chart. I mean, there could still be a lot of countries, and the definition of lockdown varies. But in general, you can see that almost 1/3 of the world economy has kind of stopped working. Either shops have closed, or like in Singapore, construction activity has stopped, and so forth. So I mean, there's no doubt there'll be a recession. You don't have to ask that question when 1/3 of the economy is actually in shutdown mode. But again, this is positive in order to contain this virus, and in a way this is necessary. So this is the second reason why we're positive. Next slide. The other is of course the record low interest rates. Just a reminder, we've been having low interest rates for a very long time, but just a reminder why it is at least positive in the near term. It's a growth stimulant, positive for asset prices, and of course it makes equity valuations more attractive than bonds. And of course, you will now be the most sought after kind of asset class. Next slide. Okay, the next one is, of course, the governments are kind of underwriting the downside. There's only a limited amount of things the government can do. I think when you have an industry where the revenue is zero, then there isn't much a government stimulus can help. But what you can do is just cushion the downside. As you can see, this is as of 30th March. This excludes what we have, no additional 5 billion in Singapore. In the US, they are talking about phase 4. There could be another, really the number is up in the air. There could be even another 2 trillion coming out from the US. Of course, some of this stimulus, the quality of the stimulus varies. If you're talking about actual handouts, wage subsidies, then that's positive. A large part of it, like some in Malaysia, a large part of it is actually just government guarantees, which doesn't really help. When your revenue is zero, there's nothing much you can guarantee. So again, what happens is basically the positive that the governments continue to stimulate, maybe even overstimulate to a certain extent. But anyway, again, it's just to cushion the downside. The fifth reason is that when we look at on a longer term basis, the performance a bit complicated. But anyway, the first column on the left, the worst 15. So in terms of a 3-month performance, in terms of how much have the STI moved in 3 months, you can see that probably ours is the present as of March is the 12th worst, all-time 12th worst. And you can see the prior periods whenever you buy into this into such a sell-off. Again, this is not predictive. This is I'm just looking at the rear view mirror and just telling you historically what has happened. So it does pay off when you have a major sell down. The returns can be 50, 28. Again, this is not prediction, foolish to kind of extrapolate or predict this. But what is just say that the odds are with you, and you tend to have quite a good returns. It pays off when you have such a massive selling. The only one time it didn't happen was in October 97, as you can see. Even after 6 months and 12 months, the market still collapsed. Again, that was the beginning of the whole Asian crisis, and it took like almost 12, 18 months for it to iron out. But most periods, again, this is just historical numbers, the returns have been quite attractive on the 6 and 12 months, but not on the 3 months. The 3 months it's almost like a random, some positive, some negative. The reason is, of course, the valuations are at GFC levels. You look at dividend yield adjusting for the current low interest rates, and of course, you look at the price to book. We didn't use PE because, as you know, PE now probably going to get a bit of downgrade, so PE may not be reflective. But if you just look at just price to book, we are actually at almost all-time lows, lower than the global financial crisis. The reason why it's called reason 5.5 because the Singapore market has always been cheap and it still gets cheaper, so it's not the best timing. Valuation per se is not the best timing tool, but anyway, it's good that it's attractive at these current levels in terms of the valuations. Okay, the only thing that holds us back is the number of new patients continue to rise. Actually, the latest number now is already hit 90,000, so we probably hit another new high in terms of globally the new confirmed patients. So it makes us nervous to call a bottom when this continues to rise, because so long as this continues to rise, the number of new patients, total patients will keep on rising so long as even one new patient, the total patients will continue to rise. But in terms of new incremental patients per day, it is still rising. You already hit 90,000 again as a new record. So long as this thing keeps on climbing, the governments may still have to prolong the social distancing, and the economic pain may prolong a little bit longer. So that's why it makes us a bit more cautious that we might retest the bottom if this thing keeps on climbing. That means we still are not containing this virus. Then there'll be no more economic pain. So that's why this chart is very important and probably hard to call like a bottom until this thing comes of stable or peak or start to slow down like what we saw in the China and Korean numbers. Okay, in terms of as you know, we have an absolute 10 model portfolio which we will revise every quarterly. We didn't do much revision because everything has dropped, so obviously everything looks attractive. In terms of the performance, as you can see from the table on the right, we were down. We were not immune to this sell down. Year to date, from 20, we were down about 18. Again, this is just illustration. It assumes a 10% allocation to each stock, equally weight, and we kind of rebalance it every month. But what has happened, we've also made some movements, although we did outperform, but I guess when you're losing money, it's only a consolation that you outperform. But I mean, just one last point of this, that the major changes that we made is a Thai beverage. I think we took out Singtel. As per our report, I think we are just a bit concerned about Singtel. They did get a bit of pop because they were selling they might sell some of the Australian towers, but we worry that the competition in Australia is going to intensify quite significantly. So that's why we took out Singtel. We put in Thai beverage. I mean, this is still a consumer stock that's trading about 12 times and also dominant. They got like 90% market share in the brown spirits business in Thailand. Is kind of unheard of. I mean, they virtually monopolize it. Okay, and that's the reason why we have a Thai Bev. The others is of course the worst hit, as you can see from the title of this slide, is that there's no cover. The worst hit was actually REITs, Escort, and so forth. But as Natalie mentioned, these stocks are already trading at 0.5 times. To kind of sell it right now, it's probably not the right thing to do because they already kind of reflect the low valuations. Okay, and also, I guess the way to play this is that you virtually have to write off 2020. I mean, for some of these REITs, you can expect a sharp cut in dividends for this, and you're actually buying it more for FY21. Okay, move on, next slide. Okay, we don't want to do a lot of economic data because we don't want to keep on showing economic data and there's no decision. But anyway, we just put on 3 slides, which is what we think are some of the more pertinent economic data points that's come out. The first one is probably in the US. What we've seen is a big spike in jobless claims. As you know, in the US, what happens is that if you're out of job, which is not due to you quitting and so forth, you actually can claim insurance unemployment benefit. So what has happened is that the red line, because it's the average, but what has happened the last 3 weeks, about 17 million have actually applied for unemployment benefit. So what has happened, basically 17 million people have just gone unemployed in the US. So don't be surprised is that you will see a big jump in unemployment rate. If you do some back of envelope numbers, you probably hit like a 20% unemployment rate in the US in April. As you can, during the Great Depression, the unemployment rate was 24%. So to give you some context, don't expect any strong consumer spending out of the US. The growth in US is going to slow very sharply and very steeply in April and even in May. The only comforting thing is that this is not like a global financial crisis. These things are like turning on and off. It's like like right now everything is shut down. Then when everything is turned back on, the market you can get a big V-shaped recovery. But we just want to note that you will expect there's a huge amount of unemployed in the US, and it's going to hurt a lot of consumer spending. Anyway, what we see, as you can see in China, what happens when you turn on and off the economy is that you will get a V-shaped recovery. That's what has happened in China. The red line, which is the PMI survey data. So, but again, this is manufacturing, easy to turn it on and off, but in services, a bit harder, and some will be more structurally, like retail and hospitality. I don't think you can turn it on and off. But you probably take time until you find some vaccine. I guess so you take time for all these businesses to go back to return to norm. Okay, last slide for me. Just a quick one on Singapore. I think nothing special. I think this is kind of expected. This is the latest March data. Most February data in Singapore actually held up quite well, but I think the March data, you can see there's a sharp drop in PMI, which is basically manufacturing activity, and you can see that it's dipping back to global financial crisis levels. So obviously the economic situation in Singapore isn't great. Okay, I mean just a quick one for this. Okay, I think that's it for me. Thanks everyone. I think we can go to Q&A.
Hi, there's a question on support resistance on the Thai Bev and ST Engineering. So just give me a while, I'll pull up my chart. Yes, now I'm on my chart. For Thai Baht is still on the downtrend, and then the support resistance, the resistance level is actually at 0.7440. But however, as today it opened lower, so the immediate resistance will be at 0.685, which is last Friday top. And then last Friday it shows a shooting star. So I believe, and then the bullish recovery is showing a steep rising wedge. So I believe that it might have a continued. In other words, it might have a slow bullish momentum. Okay, let's move on to ST Engineering. So let me pull out the chart again. So for ST Engineering, it's the same. Immediate resistance is at 3.35, which is the last Friday close. And then as same as Thai Beverage, this time around it shows a graveyard doji. It means that it's a very strong bearish signal. And then plus also it closed at a lower level today. So if you want to look at the ultra resistance will be at 3.69. So once ST Engineering break $3, we'll see a strong bearish downside again, renewed downside. Okay, I hope that answered your question. Thank you.
Okay, there's a question on the recent credit ratings watch on local banks, whether there are any immediate impacts on the financial stability. And also, okay, so the follow-up question to this was that there was a recent halt in share buybacks by the banks. Any impact on potential dividend reductions? And if so, which of the three banks are at risk of a potential dividend cutback, similar to the European and UK banks in recent weeks? Okay, so I want to say, I think because the 6th of April's MAS circular, they actually did mention there was some part where they say, they kind of relaxed the regulations, and they hope that the banks don't take advantage of this by doing share buybacks or keeping out these non-compulsory dividends. So of course, I think a lot of people misunderstood MAS intention of this relaxing of capital. I think what they'll do is definitely the banks themselves, they will have no problem adhering to the current standards. But because the government actually wants to support the economy, they are relaxing the rules such that these local banks will play a bigger part when they want to provide loans, extensions, and everything to these small businesses that are ultimately a big part of our economy. So right now, it is not a matter of whether they can adhere to these credit ratings, but more of how much they can do to help support the economy in the meantime. So when it comes to potential dividend reductions as well, we can see I think there was HSBC and Stanchart that have cut dividend totally. When you talk about how whether local banks they will have the same difficulties is quite different, because structurally when we look at local banks versus the foreign banks, what happens is the foreign banks, yes, they do have higher earnings, but when you take into account the amount of allowances that they cater for every year, even in a normal year, it is about 20% of their net profit before allowances. Whereas for Singapore, it's all lower than 10%, except for OCBC, which they had an exceptional increase in allowances because what happened was last year they had the oil sector in the third quarter, there was unexceptional losses. So I don't think as of right now we are not looking at any potential dividend cuts, and even so it will, I mean, the banks will definitely follow up. They won't let this, they know how much it affects them as well. And I don't think credibility wise they don't seem to be anything close to cutting their dividends right now.
There's a question on what's the take on oil prices. I can only answer on a technical view. So technical views, oil actually had a rebound like on last week, and I think 2 weeks ago on the 30th March. 30th March was a very good rebound. But however, do take note that the rebound did close above the $25.88, which is the multi-year low. However, that resistance, right, it was swiftly reversed back by forming a weekly tweezer top with a bearish candle. So right now, market open at based on daily chart, market open with a bull I mean, with a bull note, but however, to take note that $32 is the ultimate selling point, which is the psychological resistance level. So if $32 did not hold, we can see that price of oil is continuing to decline. Okay, I hope that answers your question. And then the last one is there's DBS. Okay, DBS. I can refer to my report on back on last month. Yes, is based on the three major banks. The tanker views on three major banks. Basically, the resistance is at $19.60, but as of today, the market open edging higher. So we believe that price is going to have to continue to edge to $20 to $20.60 before a sell down. So do take note that DBS is still on the bearish downside. Okay, I hope that answers your question as well. Thank you.
Hello, here's a questions about the China's constructions and infrastructure stocks. The first question is is there will be any disruptions about the supply chains? For these questions, I think currently we are seeing the inventories of the raw materials of the iron still remain at historic highs. It will to support the productions of the irons for the next quarters. Secondly, I think in China's the raw materials of the irons accounted for about over 30% of the total iron in the world, and over 17% of the irons are sold in the China mainland. So I don't think there is interruptions. The interruptions of the supply chains will affect the industries a lot in China. The second question is the focus about the iron price, given that there could be a resumption in the demands for the construction project. Currently, for the raw materials, we are seeing the remain stables. Also, from the March we are seeing the iron price has been stable in the range of the 3,000 yuan per ton to 4,000 yuan per ton. So with the high demand, we are seeing the slightly up, but won't affect a lot. I hope that answers your questions. Thank you.
Hi, so I have one question about the REIT sector and the potential defaults from tenants because of the COVID-19 temporary bill, which will protect tenants at the expense of landlords. So the question is whether or not we affected in the potential DPU cut, even from the industrial and commercial REITs, and hence if there will be more downside risk in the prices. So the answer, yes, we do recognize that there will be some DPU cuts, and also the bill that has not been passed. As mentioned, the REITs Association of Singapore has actually written an open letter to the government outlining the detrimental effect the bill will have on the S-REITs as well as the S-REIT ecosystem. So our target prices are currently under review, but just to share, our TPs are derived based on a DDM model, dividends discount model, and it's about 3 to 5 years DDM, and it's more of a long-term view. So we will progressively review our target prices. But that being said, we do not think that the price cuts will be very significant because for our DDM model, most of the prices, the target price will actually come from the terminal value. So this COVID situation will impact the near term, which is for this year and maybe the next year, DPU. So, and hence we expect lower dividend yield for 2020 and potentially 2021. Maybe one more from me. We have a question asking if Keppel Infrastructure Trust is a good buy. So unfortunately, we are not able to comment on this because we do not really follow Keppel Infrastructure Trust.
Okay, there's also a question whether there will be a possibility that there is no dividend paid out from equity due to this pandemic. Definitely, there is the risk that we can't. I mean, you already start seeing some firms starting to cut back, but I mean, when you are looking to buy into dividend yielding stocks now, I mean, the REITs, they will have their, I mean, ultimately they have their dividends pegged to their net property income. So yes, there's a reduction, but I don't think they will cut it out totally. As for banks, they are financially still very stable. So likewise, I will believe that there won't be any dividend cut. But as for other equities, definitely it will all depend on how big the impact is to the company itself. Like it will differ firm to firm, equity to equity. So definitely those that are more healthy in terms of their cash flow might be able to support their dividend payout. But ultimately, if they need to conserve their capital for future, for the longevity of the business, then of course they will definitely cut their dividends as a first thing to do. Yep. Then I think a lot of people are also asking whether there's whether we think that the market is running ahead of itself, whether there'll be another big decline. I think we also hear Paul mentioning that yes, right now the number of infections per day is still going up at a very rapid rate. We are not seeing a slowdown. Right now, definitely there's still downside risk, and even our technical analyst Wei Ren has also mentioned that we are likely to see, yes, the market might be rallying in the short term, like a short-term rebound, but afterwards we might see another wave down. So anybody who's trying to enter now, we definitely must be careful. But so it's always better to wait out in this current period if you are still uncertain. But if you know that current prices valuations are already a very good deal, then like Paul said, if you wait out, you are able to wait out for 6 months to 1 year, definitely it is still very attractive, because 6 months down the road, 1 year down the road, your returns, your probability of getting the returns will still be quite high. I think there's another question on any suggestions on global healthcare stock. Currently, we do not have a particular focus on global healthcare stocks, but just take note that structurally, of course, the US healthcare, they are like the big pharmas and everything. They have very big power, but barring this pandemic issue, when we look at it structurally, right, US healthcare stocks generally right now they are very protected by the government. But if there is a case of the government coming in as a player themselves, then it might be structurally change the entire industry of the US healthcare stocks. There's something to look out for. But as of right now, definitely in the short term, it can be a very tactical play. I mean, short term wise, based on the current pandemic, all of them, especially for the medical equipment provider, they should be quite positive, but it might have run ahead of itself again because the supply chains to produce these kind of supplies. It might be a bit short-handed in the meantime.
For the question about the SIAX rights price, whether it's a good buy or not, we have to look at the situation of the virus. You know how long that they were shut down for. Currently now, about 96% of their fleet is grounded. So we have to wait and see how long it will pan out. All these travel restrictions and all this. So we can't really project so well based on the situation at the moment. So I think there are other better opportunities to look at elsewhere, if you ask me.
Yeah, and any for SIA, as Paul here, any for SIA, you're not going to buy this for valuations. You're just buying it for momentum in the news flow. So when there's an inkling of this thing getting resolved, you just trade it. The problem with having government bailouts is that the bailout is not only for Singapore, the bailout is for globally. So how do you compete in the industry where government keeps on bailing you out? What it means is that there is no profit motive in a way. Everyone is any company that goes into losses, the government will bail you out. I'm not talking about Singapore, I'm talking about other countries. So in this type of environment, how do you compete? So there's no competition for profitability. It's almost just for strategic purpose. So for SIA, for us, we are a bit worried because this is such a massive capital raising. There will be a lot of captive sellers that we mentioned before. So that's why we were a bit worried. And the only time you should come in is when you got the inkling that this thing can be resolved. There is just imagine if there's one new announcement that the travel restrictions are lifted, just a little, SIA will rally. So you're just buying SIA for a trade. I mean, the SIA share price has been dropping for the last 20 years, even before this COVID thing. Because because of structurally, airlines are always very problematic. So my answer we can give you is that just buy or play on the news flow. Don't even have to look at valuations because it's all cheap. So you just time it based on your expectations on when this thing can be resolved, or just it doesn't have to be totally resolved. Just a marginal improvement in travel restrictions, and this stock will just pop. So that's how you play this SIA. Don't even have to look at the balance sheet, I guess. Sorry, let's give you a long answer to a short question. Okay, I'll just try to answer some of these. We don't cover all, but we just give you what's our view. Firstly, are you able to touch more on oil prices and the latest influence on the stock market? Okay, and on our Singapore stock market, obviously the ones that are most exposed are the yachts. We used to have, KrisEnergy. If you want to play oil, you can buy KrisEnergy because they were exploration. But again, it shows how problematic, what an issue. That being an oil explorer is such an issue. Even though you're backed by Keppel Corp, you still go into receivership or I think liquidation. So what I'm saying is that just play on the oil price and maybe not the best time, not a good way to buy oil through these oil explorers. But anyway, the impact for the yachts, oil price on the Singapore market at least will be through the yachts. But again, do remember that the order books for these yachts were already falling even before. When they exited 2019, the order books were already down, like still falling. So with this current oil price, you can forget about any exploration work. It's probably not going to get any order. The only angle to play the yachts, my guess, is probably this would force them likely to merge. The chance of merging, although the rumor of merging has been around for maybe probably a decade or maybe 2 decades, but with the current situation, as the market look for global champions, the only play is maybe some merging between the yachts. So that would be the angle. But again, structurally, all these yachts have problem turning any profitability. It's almost like buying an airline, if not worse. So so my take on this is that the impact is only through the yachts if you want to play the oil price. Yeah, I hope that answers it because we don't really cover the yachts. We kind of gave up anyway. Thanks. I'll move on to the other questions for the rest to answer.
There's a question on where's the best price for Yangtze Jiang and Sheng Siong. Sheng Siong, I'm not very sure, but for Yangtze Jiang, if you're looking to buy, right, it's actually the best price is to buy is 0.750, which is the 61.8 extension level. I think if you have read August version of the chart point, that which I wrote, I think although it's quite some time ago that I did forecast that the best price to buy for short-term buying is actually at the 61.8 extension level. If you need it, you can type my name in the Google search, you can refer to it. But right now, for Yangtze Jiang is it's kind of late to actually enter into the market now. Firstly, last Friday it actually had a shooting star, and then today it opened higher, but it's actually forming right now based on the 4-hour chart. Is forming actually a doji sign. It means that the bullish momentum is actually kind of losing. So I won't suggest on buying for Yangtze Jiang. I hope that answers your question. Thank you.
Okay, I will just try to answer. We'll just try to run through all the questions. I think there are another 4 more. Okay, is it again? Thank you everyone for sending us your questions. We appreciate it. Is it better to buy the index in the current situation versus individual stocks? This one is a really tough one. If you don't have the time or you don't feel comfortable with picking individual stocks, then just buy the index. If not, you can even buy the ETFs. Some of the REIT ETFs, I think that is quite attractive because you got already this big sell down, like Natalie said. The REITs are already sold down even more than the STI itself. And then as you mentioned earlier, yield is now the most sought after thing. Although the dividends will be hit, but if you assume that this is a near-term FY20 and not FY21 scenario, then maybe some of these REITs, like even some of the ETFs, the Philip ETFs, the REIT ETFs, that may be a bit more attractive because the yields are better than the STI itself. Again, this is your individual preference. We can't really answer that for you. Again, if you're not comfortable with picking maybe banks and you want to diversify across a whole suite of stocks rather than take any single issue risk kind of situation, then I think the index or even ETFs are even more ideal. course not funds. That's probably not the right thing. But anyway, ETFs is probably the best thing. Maybe the STI REIT index could be applicable for you. Yeah, I'm just thinking very generally. Yeah, again, thank you. Okay. Do you think medical restocks like MP? What is that? So I'm not sure what is MPW. Anybody can answer that? Yeah, so sorry, not familiar with that. We probably will have to miss that answer. Anyway, what is your take on SPH? SPH released their results recently, and we were in the call. It is going to be very challenging for SPH. Again, SPH is going this transition where they're having structurally turning structurally problematic in their media business. How many people are actually reading the ads? I'm sorry, how many people are advertising on print? And then they still have a lot of classified revenue, which is pure profit, and that is also coming down. So they were buying a lot of the dorm business, student dorm business, to offset this. And again, as you know, with this COVID situation, all the students are leaving the country. So, and then you cannot withhold the deposits because I think the government, everyone has to kind of repay the students those deposits. So they're getting hit on both sides right now. I mean, the media business is weak, and even the dorm business is weak. So it's probably a void for now. That's all we don't cover, but this is our general thing. Viren, I think you answered this, right? What's the near-term support for STI?
Yes, I've answered already, but I don't mind.
Oh, okay. Thanks.
Can you? Yeah. So let me pull the chart first. So for generally, the STI is still on the downside. Like what I mentioned during the sharing, during the webinar on my slide just now. Near-term support is actually at 2562, which has already been broken. So we'll be seeing immediate upside near 2673 to 2700. So or if you break higher, we'll be looking at 2800. So these are the levels that the crucial Fibonacci retracement level that we are seeing. So right. So I hope that answers your question. Thank you.
Okay, so we have a question on how the COVID situation in US affects Manulife, or the take on Manulife. So as you know, we do not cover Manulife, but we had a call with the management. Overall, the concerns for Manulife was whether or not the tenants can actually claim any force majeure insurance against Manulife, and whether or not there were any break leases or any covenants that allowed the tenants to give back the space. So for those two questions, no, because according to Manulife, their buildings are still open, even though the country is some of the states are in lockdown, but because their buildings are technically still open, no action can be taken against them. And also, there are very few leases actually have this covenant or this clause that allows the tenant to give back space. So actually, what the management was trying to say is that most of the leases are secured. There's no way for the tenants to break it. From an investment point of view, we do like Manulife because of their future-proofed tenant mix, which is very high percentage of it is actually in tech companies, which is a growing industry for the US at least. So with their portfolio of trophy and great Class A assets, Manulife should be able to withstand this crisis because of their tenants, which are mostly very large MNCs or some of the government agencies that are in their building. So overall, still quite positive for Manulife. We have another question on what is the target price for CapitaLand for the short-term play, i.e. Less than 3 months. This is a bit difficult for us to answer as fundamental analysts. So I'm not sure whether Viren has a take on this. Perhaps he can give you from a technical point of view.
For CapitaLand, it still fails to break $3 psychological resistance level. So and then last Friday it shows a strong bearish reversal signal, and today it closed even lower. So I think that short-term buy, you may look at for short-term scalping, you can look at $2.62 to buy, or but do look out for any reversal signal. I hope that answers your question. Thank you.
Yeah, I think we probably have to skip the Eagle Hospitality. Sorry, I don't really follow. We got some last few ones. Any opinion on Genting Singapore? Any insights on why the share price keep rising while casino and RWS are shut? Thank you. Actually, we don't know. You probably answered the question yourself. We still don't know when you shut down why it's still running. We really no idea. We really answer. There's no revenue. The only thing is that they got very good cash flows and that can sustain them. But again, we're not sure. It's probably just ebb and flow with the whole with the market flows. Yeah, we're not sure. We didn't hear of anything. Sorry. Okay, we'll just take one last one. What's your take on Valuetronics and UMS? Actually, we're kind of positive. We don't cover, but we're kind of course, we follow them for years. But we're kind of positive on Valuetronics. I think they're trading close to cash or very near cash. So I think it's really kind of attractive at this level. And of course, there will be some disruption, but you know, this company like Valuetronics have ridden through the global financial crisis, and they're not running on large consumer business. What has impacted them was because of the whole China disruption. They're just in a bit of a transition because they have to start a new factory in Vietnam. But we think it's quite a good, it's a good company. And for UMS, I think semiconductor demand is really strong. As the last time we checked, I don't think there have been any customers pulling back on orders. But the problem has been, as you know, Malaysia is under lockdown. I think their lockdown is even more severe than what's happening in Singapore, and factories are closed. So there will be a short-term disruption on their ability to supply. It's not only on the ability to manufacture, the ability to ship goods, because as you know, cargo slots, plane slots, and so far are all also been curtailed quite dramatically. So as a result, it's more of a supply situation. Demand seems to be holding up for now. But again, even demand for technology stocks, we're kind of a bit wary. I think with this, what's happening in the US and so forth, apart from certain categories, maybe notebook and so forth, I'm not sure how smartphone sales are going to do when everyone just lost their jobs. But I think for both stocks, I think there will be a temporary bump because of this whole supply shock. But I think these are both quite attractive stocks in general. But again, just a reminder that we don't actually cover them. But this is just our own views. I think that's it for now. We got one more stocks, but it's actually a US Activision Blizzard. Sorry, we don't cover that right now. We don't cover US stocks. Anyway, thanks everyone. Thank you for attending. Really appreciate all your attendance and especially all your questions. Sorry we can't answer all. Some are beyond our scope. But again, we really appreciate all the questions that you asked and thank you, and hope to see you in 2 weeks' time. Thanks everyone.